Let's welcome for our next speaker for today, Dr. Erik van Dijk, apologies, who is EMFM Advisors and Parmenian, is that right?
Yep.
And so your topic today is value creation via InvestTech, digging deeper and deeper and deeper and doing things differently. Dr. van Dijk started his career as an academic in Amsterdam and at the University of Chicago. Here he created the basis for an innovative quantitative investment management system together with, now this is wonderful and very impressive, together with Nobel Prize laureate Dr. Harry Markowitz. And I believe that you collaborated on a paper together as well, which I think we might have information to share below in chat. Dr. van Dijk then left the academic life to create, well, his academic life at that point, to create a startup company via which financial information about equity markets and output of the quantitative investment systems was made available to smaller institutional and ultra high net worth investors. After about 15 years in institutional asset management, he then moved on to focus more on his proprietary investments with a special preference for emerging markets and selected tech investments. Dr. van Dijk's focus in investments has always been on fair growth for the long run at a reasonable price. Dr. van Dijk is also a specialist in Islamic finance. Is there anything that you haven't done? I do wonder.
I've done the whole circle, I guess, but that's the advantage of being old. Huh? Then you have the time to do the whole circle.
Well, I'm very much excited to hear your presentation, and the floor is yours.
Okay, thank you. So basically, when you asked me to do the presentation, and I was honored by it, I thought, okay, InvestTech, you can interpret that in a lot of ways. On the one hand, there's the word investing in there. On the other hand, the word tech, and there's a lot of tech investments from medtech, fintech, consultech, edtech, etc., and they all need investors. And there's, of course, InvestTech, the word which really limits itself to, let's say, a subsegment of the fintech market, namely solutions for the investors, the institutional investors, via which they can then enhance the return corrected for risk that they can make on their portfolios. So basically, when asking, okay, what direction shall I go? And knowing that you would have such a diverse audience, I thought, you know what I do? I go for the smallest of these possible ways of defining InvestTech, namely the InvestTech as the subsegment of fintech, namely how to sell things to the guys that in the end will, for everybody in tech, be their investors as well. Huh? Because a lot of people always forget it. Venture capitalists, private equity parties, they don't have money. Behind them is always either an institutional investor with money, a pension plan, a sovereign wealth fund, or family offices, ultra high net worth type of people, of whom I'm now happily one of them. But in the past, when I started, I was just a professor knowing a bit about tech and quant and this kind of stuff. So this full circle there has helped as well. And I thought that what I can give the audience then is this inner look about something that is, for many people so far away, so much opaque, obscure almost shrine, where they think, how the hell can I sell my stuff there? How are these guys approachable? Well, they are, but actually it's not about digging deeper and deeper. It's about doing the things that you have in mind differently. That should bring you from where you are to the next spot. And why is that? Well, actually, think about this here. Venture capital firms, the LPs, is the guys with the money. And the guys with the money seem to invest less in wealth management related fintech than in other types of fintech. How is that? So the ones who really know the situation where the venture capital firm has to convince a client who actually is the customer of this specific product as well, is the lagging part of the whole tech development. That's weird, because you would expect that if they really have to put their money into something that they know, because they will be the users themselves, that it should be an easy way to get money for that. And somehow it's lagging. And I find it weird also because, when I was a professor and did a fintech in a way, avant la lettre startup back in the end of the 1980s, using the new technology called email and floppy disks to bring financial information to ultra high net worth and small institutional clients. It took me a couple of years, and a big insurance firm bought our little firm. So was that because it was simple? No, because don't forget, in those days, email and floppy disks was just as much fintech as the more sophisticated stuff now. Never forget, what is rocket science to the outside world is daily use stuff for the rocket scientist. So there is something fishy about this thing, that the big potential users don't seem to buy a lot of stuff in wealth management space. So there is a mismatch there, either in language or in the way the parties with good products try to sell it. And I hope to take you through slides that may help for any one of you who tries to sell to big finance in getting their attention the right way, so that you either get funding or maybe sell your product to them, because both are of course possible. Here's a slide in between, which actually was not in the one that you have, so you get this updated version from me. It was the result of a little dialogue I had on LinkedIn with a couple of outside people that felt that they had the fantastic product in the world and that it should be bought by the big institutional investors. I made a little exercise here saying, okay, suppose I make 10% a year, that's the first column there, on some kind of institutional equity product. Then after 10 years, this has grown to 2.5 times the initial amount. So if you say that you bring some kind of InvestTech type of product that does 5% better, yeah, you are a little bit further after 10 years, namely at 4. So, okay, you can sell something to this institutional client saying, hey, I can make 5% more than what you're currently making. So this is quite interesting. And if they will then say, yeah, but if it's so great, why don't you use it yourself? You can say, I'm too small, because after 10 years, it's just 1.5 times added compared to the 2.5 that you make. I'm 4.04 times the initial amount. And yeah, my amount is so small, doesn't make much money to me compared to what it does to you. But that's not what happened. I mean, that's a feasible strategy and it makes sense and the guys would listen to you. But what you see very often is that people say, hey, I'm this offer, you can't refuse a product that I made. It's artificial intelligence. It's a lot of rocket science and it's fantastic. And I dig through a lot of daily data and I can make 40% a year. Now, suppose that's true. See how quickly after 10 years, this amount of money that you have goes up. So suppose that it's really true that you sell me something that makes 40% a year with the same risk as what my strategy with 10% a year is doing. The 2.5 has become 28 after 10 years. And you often see people 25, 35 years of age who then say, yeah, I can make 40%. But if that's the case, why don't you go to your bank, borrow whatever money you can get, and don't bother me with trying to sell your product, right? Because it doesn't make sense. You're either a lousy entrepreneur or you're lazy and you don't want to start a business. Because if it's so much better without additional risk, you should do it yourself. So the moment that you have in your business model where you try to create a tool for the big finance guys that is fantastic, make sure that you know this math. Because if you're very young and you're 25 and you will do this thing 20 years, you would never even need an investor. You would just do it yourself and be very well off. Look at the situation after 20 years. So this is a first warning. And it always happens. You still see it a lot, that people try to make an offer that the big investor cannot refuse and forget that if you do the math yourself, that the offer that can't be refused is an offer you would never bring to big finance in the first place, but you would start exploiting it yourself. So this is just something for you to keep in the back of your mind when we go further. And there's another one, and that's one that actually popped up the other day when on LinkedIn, a guy was basically attacking my old friend and partner Harry Markowitz for saying MPT, modern portfolio theory, is stupid. I'm this 25, 35-year-old guy, and I had 4 or 5 good years, and I can easily beat the market. Well, okay, but then this exercise. If you have 1 million investors, each of them without any strategy, they have, let's say, a dice-based strategy and 50-50 chance of beating the market. Let's say their strategy is that in any of the years they will buy long or short when the numbers are 3, 4, 5 versus 1, 2, and 6, something like that. Sounds sophisticated, but it's not. It's just dice throwing. It takes 21 years and you're still left from this 1 million people with one guru star who beat the market in every year. So this guy has 3 business cycles, every year outperformance. So probably already a lot of followers. But don't forget, the next year, he's again throwing dice and he's just as stupid as the rest. There's a 50-50 chance of him to underperform. That doesn't change. So the fact that there are so many providers out there who want to get to the big finance, with big finance knowing very well this story, means that the moment that you try to go that direction, you already understand why it's so hard to get their money. Because they keep this always in the back of their mind. Now let's see, because I'm definitely not pessimistic for anyone who tries to sell to big finance. I think it is doable the moment that you talk the right language. So InvestTech, as the combination of any technology and strategy that you could use to help investors get better risk-adjusted returns, that is indeed something where big data and AI may have a role, but it's not the buzzword that immediately would get them horny. Actually, there's not so much that immediately gets big finance horny in the first place, because they are very, very risk focused, and they have to be because their clients are incredibly big. Maybe one nice anecdote there. When I sold my firm to this big insurance company, and I brought in a guy that was with me in the university, a fantastic, brilliant scholar. Our first client was a pension fund that gave us 250 million guilders in those days, which is still a reasonable amount if that's your first investment portfolio that you're going to work on hands-on. The guy was great in university. The moment that he had to buy real shares, he couldn't get away from this feeling, oh my God, I'm buying this relatively tricky technology company with high volatility. Oh my God, what if it goes wrong? So he kept on thinking about, what if it goes wrong? What will Erik think? What will the bosses think? So somehow it was in his mind that the size matters indirectly, as in saying, yeah, but with big amounts of money at stake, it's different. So the guys in big companies, especially also because the third-party providers of that money are powerful institutions themselves, they don't think in terms of buzzwords, but they sound often very skeptical. They do definitely believe in technology, but don't make it sound like buzzwords, because you really will see that the fence between you and them will go up. But deep down the line, it's much simpler than you think, because net risk-adjusted returns being higher than what they have at the moment, well, that could be something where you need rocket science and AI. But if it's something that could help them reduce their cost levels, for instance, something simple as, let's say, you create a website where you have YouTube movies of 20, 30 minutes with the same kind of questions that they find important with every CEO in your universe, they would love that. And that's very simple. If you have 100,000 stocks, just try to get 100,000 CEOs with little movies and get some storage for that. And it would save them 1-2 trips where they would visit potential candidates to put in their portfolio, simply because they could have the CEO answer their questions whenever they want to have the answer. Because it's quite a hassle to get CEOs of stock market listed firms on the phone at the time that in another time zone the institutional investor wants it. That's not a rocket science product. It's one that cut the cost by saying, hey, if we have such a product, we would have to travel less and would have less coordinative costs in terms of when can we talk to the guys. So such a kind of simple product could be a fantastic hit with big finance. And that is in a way why in payment systems and payment services, you saw a lot of fintech succeeding, because it was far clearer that the guys who created the tools or the new products understood what was worrying the big investors. But here, small, simple, different could be keywords just as important as big, more, deeper, etc. But let's start then doing the same thing. How big is big? Here you see a few pieces of data that there is gigantic amounts of information out there. All the numbers are in the thousands, hundred thousands, millions, billions, and even terabytes. And the big institutional investors in most places in the world deal with already, in terms of investable space, 150,000 companies as well, and a multiple of that in private company candidates. So yes, there is an enormous amount of information out there. Now, shouldn't that be so compelling that you automatically then sell anything related to making big data available? No, because I give you an interesting piece of research that was brought to market a couple of years ago by Robeco, the big asset manager from the Netherlands. 3 of their quant researchers wrote a nice piece about what they called the conservative formula, which is a very simple equity strategy using 3 pieces of information that everybody has at their disposal, even if they have something simple as Morningstar, Simply Wall Street, or any other data service. The only thing needed is volatility, momentum of the stock price, and dividend yield. And basically the strategy said, first, get rid of half of the universe of stocks with above average volatility. Forget about them, too risky. Then with the half that you have left, say, okay, now let's get rid of the 50% with no or low dividend yields. So take the highest 50%. And then last but not least, get rid of the half of that group left, which has the lowest stock market momentum over 12 months. So pick the ones that have the best looking charts over the last 12 months. Then you are left with 1/8 of the companies that you initially looked at. And if you create a portfolio using this very simple strategy, well, it's very nice to see you would outperform your market universe relatively simply. Not by the 20, 30, 40% that I showed in this food for thought slide before, but you will beat your universe. So the big investors who basically have oil tankers to steer and not speedboats out there know that there are a lot of relatively simple algorithms available that could help beat the market. So more could be interesting, but not necessarily the way to go, because simple might already get people a pretty long end from where they are in terms of creating outperformance. That may again sound that I'm somewhat skeptical there. No, I'm not, because if you look at what is internally in there in tech, there's 5 elements that are really very interesting to the big investors that are part of, let's say, the end clients of anything fintech related. Analyzing behavior and finding patterns, that's what quant investors do for a living day by day, and even fundamental investors who are not quant, they love to have better and more information about patterns and behavior, as long as it's proven that it works and manageable when trying to incorporate it in one or the other strategy. Multiple data source combinations, for sure. I mean, if I have segregated data about A and B and I can combine them to create C, of course, that's very useful. Just one example, suppose you have great information about a country, let's say China, and you have great information about a certain sector, let's say health, then information about A and B that can be combined into some kind of, easily written, predefined report about the Chinese healthcare sector. Yeah, I would love that. Tell me more about it. The third one, less sexy, but definitely important as well. One of the problems with big finance, why they can seem cocky and a bit hard to approach, is that big finance doesn't mean bigger as in having more clients. That's banking talk. But big asset managers can be big because they serve big clients. So it's actually a very small world, and customer service is not that complicated. I mean, I've been in conferences in Switzerland, for instance, where half of Europe's institutional money was in the room. It's possible because with a couple of hundred institutional investors of big sizes, that's doable. Take, for instance, in my old home country, the Netherlands, APG, the #1 pension plan, has a size in assets under management of approximately half of the GDP of the country. And if you add #2, which is taking care not of the civil servants, but of the people working in healthcare, PGGM, they have 25%. So these two institutions are good for 3/4 of national income of a reasonably sized European country. But they don't need to serve yet those small customers because we have a collective pension system. However, and that's nice that we know that now from the US, the 401k, where people individually are taking care of their pensions, it has certain advantages. And in Europe, more and more countries are looking into individualized as opposed to collectivized pensions. Now, then the customer service starts becoming very important, because you can't have all those people in the room and you want to tailor make things. So basically, that taking with us to the next slides means that improving customer service is an area where it might not even be so complicated to provide interesting InvestTech related services to the big giants. Generating additional revenue is then automatically linked to it, because if they can handle more smaller clients without a lot of extra cost, well, they might consider it. And last but not least, it could help you to be more responsive to the market. So certain markets that are segmented or hard to cover, with certain software opportunities, it could become possible to do that. Look at, for instance, the success of online brokers like Interactive, who started in the US and now basically offer their services in many countries, bringing international investing closer to the people. So in the end, size, yes, matters, but size is something that can work against you when trying to sell to the big investors. But you should make it something that works for you by talking their language and offering the things that they really want to see. So to cut this slide a bit short, because I already explained quite some things from it, it simply means that you first have to dig very deep into what big finance wants. And I think that InvestTech wealth management is the most complicated area there, because a lot of people were never managing portfolios of incredibly large sizes. So it's very hard to then talk the right language. When you try to talk as if it was your small portfolio, well, the smaller you are, the less your portfolio management looks like that of the big giants. So of the various fields of InvestTech, which are the ones where you have the best chance? And it's actually nice that Dimitri yesterday gave us a hint in that direction already. The areas where you can see that the biggest success was created is, for instance, feeder funds, portfolio aggregation, and new kind of products that would enable the creation of various setups that would enable big parties to work with smaller parties. An example is, for instance, what Vauban is doing in the UK, where they are able to help people set up their own fund or feeder fund that could then collaborate with the big giants, and the big giants could work with you as an intermediate layer without having to deal with all the small clients yourself. So whenever you would then be there with an interesting product that would make such a thing more cost effective and more tailor-made, so that the big party would say, yes, I like to work with this party because of this structure that was created, then if you can do that at a low cost, because intermediation means an extra layer of cost, of course. So when the costs are minimized, so it's not a lot of extra work and not an extra layer of cost so that the end client would be disappointed, then this is an area where a lot is possible. So in a way, to summarize, there's like, the 4 Ds of InvestTech, you could say. The first one is definitely a go for all of us. There was this democratization as a result of which anything related to tech in terms of computer power, memory, etc., became so much less costly over the years that it is becoming B2C more than B2B, simply because anybody could have certain applications now on their smartphone or laptop that in the past was only available to the big finance guys. And I like to give the example there of Simply Wall Street, an Australian little startup financial platform provider, which has a database with 150,000 companies, fundamental information in English language. It's a nice database. It's basically almost everything that a big institution would have, except that there's not real-time price information, but a couple of times per day, but more than enough to do something nice with it. I actually work with them and I created a couple of institutional style models to communicate with their databases. And I can only say, yes, you can run an institutional strategy on their platform. So if it's good enough for our size portfolios, it's definitely good enough for a small investor. So these guys did something great. But the funny thing was, they did something great without knowing where it would take them. Because when they started, and I was one of the first people to try the product there, they said, we start in Australia, New Zealand. And from Australia and New Zealand, we will then try to conquer the UK, Canada, US, because that's where people speak English. Well, they already got a little surprised because in Singapore, people speak reasonably English too, but they forgot something completely. The moment I last saw their update on how things were going a couple of years ago before COVID, they had a couple of 100,000 clients. Now they have 4.5 million. And you know what the big difference was? 4.2 million middle-class Indians who like to invest internationally and who love their service. So India became their prime market, and they haven't given that a thought when they created it. If you have English language and you talk about investing in technology, don't forget India. It's the biggest market. So that was a funny democratization where the middle class in an emerging market is already really changing the total picture. So don't forget emerging markets when you think in terms of democratization. Dissemination of information, yes, a lot of people are busy in that direction. They think that more data, bigger data, more has value. It does, but because there's so much noise in the market, you really need to be very, very, very big to really make a difference in that direction. But when you are an outsider, how to really convince the insiders that you as an outsider are good enough to give them the things that their army of PhDs didn't find. That's tough and difficult. And the moment you do, like in my case, and you were lucky, then the first thing they do is not buy your product, but buy your company, because they can't have the key man risk that you as an outsider deliver something that they are going to use on clients of 200 million in size. So it can happen, but then your company is immediately sold. The third one, disintermediation. Yeah, I mean, if you can create a tool that will help the big guys to do without an intermediate layer, then we're talking, because the intermediate layer is a hassle because the end client will pay more and they will have to deal with an extra layer. So if the things that you create in your company will enable them to serve more people at a relatively lower cost and give those people the idea that their product is tailor-made, whereas actually they just run the big portfolios that they always do, then in such a situation, this intermediation is fantastic. And last but not least, the dispensation. Big investors are not against small clients per se. They just think like this: okay, if we have to lower the fee levels to make it feasible, because don't forget, they don't believe in 30–40% returns a year. So if they think, okay, let's assume that we can make 10–11% and the small clients can pay 0.5 to 1% per year more than the big client maximum, then to make it interesting to really throw dice with a reputation to get extra small clients on board, well, then it really needs to have as a goal a multiple times X% more clients. Otherwise, I wouldn't go that direction. And so basically, you really have to have, like in the Simply Wall Street case, the story of bringing people something at a low price. They charge $150 a year, Australian dollars, for something that with a Bloomberg terminal would cost you 20K. So in this comparison, you are creating a tool that could enable the big parties to really go the extra mile. So there are definitely possibilities the moment you have the right type of product at the right moment. Also, and this is something you all know, so I wouldn't bother you too much with this one, all the big companies in the world, all the big nations, even the average guy in the street, they all are pro-tech, pro-ICT, and everybody is convinced that the things can work for them at their level. But make sure that what you offer to a certain party is indeed what the party is looking for. And too much is going bust because of this mismatch between what the end client wants and what you have to offer, especially in those cases where you forget that the end client who needs to use your product is actually also the one investing in you via the venture capitalist. So that makes the financial industry a bit more complicated than other industries. So we are only at the beginning of this stairs here. A lot went wrong in, let's say, the first 20, 30 years of quant finance. So we saw growth, but not to the max. People are getting better and better. ICT is getting better and better and more affordable. Where we see enormous growth in ICT capabilities in countries in emerging markets. And I actually think that that means that the countries where really, if you have a good fintech product, or if you are from such a country where you could really sell to interesting parties, is in emerging markets. But the fun is that everybody wants to sell their fantastic fintech product to Goldman Sachs or to Dimensional or to Vanguard. Yeah, they're very big, but they also have armies of people internally to create the stuff because they don't like key man risk from outsiders. On the other hand, they also know that 5 to 10 years ago, they had very nice clients from China, like Agricultural Bank, China Asset Management, those kind of big Chinese parties, because they were managing their US and European portfolios. However, at the moment, they're losing those clients. China Asset Management, ICICI in India, and all kinds of other big parties, Haluk Bank in Kazakhstan, they're doing more and more themselves. So if you have now an interesting product, why not talk to the big partners for the future in those countries? Because they are in countries where they don't have this old money, old network, etc. So they're far more open to new technology and new things. I remember that a long time ago now, almost 2 decades, when we didn't have any payment by debit cards in the Netherlands, that Kenya had it before we had. So you could buy in Kenyan supermarkets with your debit cards, and in Holland you still needed cash. So why was that? Because there was no infrastructure to start with in Kenya, so there was less disruptive costs compared to where the big giants are. And I think that this is the positive side of the story in fintech for anyone who is from an emerging market as a creator of fintech products, or who is working in the industry, in the financial industry, in an emerging market, and is looking for interesting products. Now, the business development managers of the interesting companies, they seem to flock Silicon Valley, they seem to flock New York, but they forget the interesting opportunities in Beijing. And if you don't want to go there, then try Singapore first. You can reach out to emerging market-based parties that do it. So in a way, yeah, this slide is my feeling of the industry, having seen it from all sides. This little, very tiny cloud, how to influence investment behavior, is what most people are focusing on. But the big clouds, with all the other type of not so sexy and exciting products, is where there is enormous opportunities. And I pick out one just to give you an example. The one below, AML and cross-border fear of FATCA, the know your customer kind of stuff. That is an area where I do now see that there is a far more activity going on and a growing interest and actually success by parties offering that kind of less sexy stuff, simply because the big asset manager would say, hey, if I have these kind of tools and my risk of getting some kind of penalty from the regulator goes down X%, that can save me so much. Hey, it might be just a tiny little improvement technologically, but it could save me 0.1% in total return. But 0.1% on the size of the portfolio of the big client could really go a long way of your company becoming an incredible success, taking into account.
I'm so, it pains me to have interrupted you, as I feel like I could literally listen to you for hours and hours and hours on end. That this is extremely fascinating. But if I could just kindly ask, because we have another speaker that we need
Sure.
to go to as
Sure.
well. And so again, my sincere apologies to interrupt. If I could just quickly ask if we could just maybe look at concluding this.
Actually, you are a little bit quicker than I, because I'm there almost.
Okay,
it's very simple.
I do apologize, and
No,
we can of
fine.
course continue during the panel as well, for sure.
No, see, the good thing is the moment you are an old school guy who likes the Q&A to be interactive, then any interruption is fine. So also this one. So I would like to summarize saying, is it logical that the sector is critical of InvestTech, and that we saw in wealth management so many disappointing results compared to the regular fintech on the payment services side? My conclusion is yes. Will this change? Absolutely. The good providers who talk the language of the investors will definitely have enormous chances to be successful. They often are a little bit afraid of regulatory kind of situations, and they find it hard to incorporate them in their product. But the moment you understand how regulators work and understand that for the investors in big finance, the regulator is not something scary, but that's the group of people that you drink coffee with whenever you have a question. The moment that you keep that in mind, then helping them in making regulatory constraints not binding is really something where there could be products already. So that being said, and knowing that there is a gigantic growing market in emerging markets will translate into, I think, a positive story also for the creators when they are from emerging markets, because I can imagine that if you are a technologically driven great company in, let's say, Estonia or Ukraine, that it's far harder to try to sell in New York than it would be for you to sell in, let's say, a neighboring other emerging market. So it's, in the end, and that's on the positive note, good for all that we have a world that is changing, and where the moment you talk the right language and go to the right potential client for your product, you can definitely sell tech way better than you think, but keep those things that I just addressed in mind. Thank you.
Thank you so much, Dr. Van Dijk. That was absolutely fascinating and inspiring as well. As I mentioned, I could sit here and just listen to everything that you're saying in your presentations all day. And I think I probably will do at another one of your conferences for sure. So we will have a panel very soon. So there are a few comments and questions that have come in from our audience, and also from our panelists as well, which I'd like to address to you later.